Episode 5, Economic Policy, Shaping the Financial Landscape. Welcome back to Money Talks, your essential guide to navigating the Canadian financial world. My name is Rita, and I am your host. In our previous episodes, we've explored the foundational elements of the Canadian investment marketplace, delved into the intricacies of economic indicators, and understood the crucial role of the regulatory environment. Today, we're taking a deep dive into a topic that directly influences every aspect of our economy, and by extension, our investments: economic policy. Understanding how governments and central banks make decisions about spending, taxation, and interest rates is not just for economists. It's vital for investors like you to anticipate market movements, identify opportunities, and protect your portfolio. Think of it as understanding the steering wheel and accelerator of our national economy. When the government or the Bank of Canada makes a move, the financial markets listen, and so should you. In this episode, we'll demystify fiscal policy, that's the government's role in managing the economy through its budget. We'll then shift our focus to monetary policy, where the Bank of Canada takes the lead in controlling the money supply and interest rates. Finally, we'll explore the real-world challenges faced by policymakers when trying to implement these strategies. So whether you're a seasoned investor or just starting your journey, this episode will equip you with the knowledge to better understand the forces at play in the Canadian financial landscape. Let's get started. Section 1. Fiscal Policy, the government's economic toolkit. Our first stop is fiscal policy. Simply put, fiscal policy is how the government uses its spending and taxation powers to influence the economy. It's their primary tool for steering economic activity, influencing employment levels, and fostering long-term growth. Imagine the government as a household manager, balancing its income, taxes, with its expenses, spending. Both the federal and provincial governments in Canada play a role in fiscal policy. The federal government handles big-picture items like national defense, employment insurance, and foreign affairs. Provincial governments manage areas like healthcare, education, and securities regulation. However, there's often shared responsibility, with the federal government providing transfer payments to provinces to help fund these shared services. Let's start with the federal budget, a financial report card. Every year, typically in February, the Federal Minister of Finance unveils the federal budget. This isn't just a dry financial document. It's the government's annual report card on its fiscal policy. It outlines projected spending, expected revenue from taxes, and whether they anticipate a surplus, a deficit, or a balanced budget for the coming fiscal year, which runs from April 1st to March 31st. Let's break down these budget positions. Budget surplus. This happens when the government's revenue from taxes is greater than its total spending. It's like having more money coming in than going out. Budget deficit. This occurs when the government's revenue is less than its total spending. In this scenario, the government needs to borrow money to cover the difference. Balanced budget. This is the ideal scenario where revenue equals spending. Now, what about the national debt? This is the accumulation of all past deficits minus any past surpluses. When the government runs a deficit, it has to borrow from the capital markets, essentially from investors like you, to finance this debt. The size of the annual deficit or surplus, along with the national debt, are crucial indicators. They tell us how much the government plans to borrow and what impact that borrowing might have on the capital markets. Governments typically finance deficits by issuing debt instruments like bonds and treasury bills. If existing debt matures, they also need to refinance it. So government borrowing is a combination of refinancing old debt and taking on new debt, crowding out the impact of government borrowing. Here's an important concept: crowding out. Capital markets have a finite amount of money available. When the government borrows heavily, it leaves less capital for businesses to borrow. This can have a negative impact on the economy. Why? Because if the supply of capital isn't enough to meet the demand from businesses, the price of borrowing, interest rates, goes up. This makes it more expensive for businesses to invest and expand, potentially slowing economic growth. How fiscal policy affects the economy. Fiscal policy directly targets the three major components of gross domestic product, or GDP: government spending, consumer spending, and business spending and investment. The government's main tools are, as we've discussed, spending and taxation. When a new budget is announced, financial analysts scrutinize it. It reveals the government's plans for spending and taxation, how our tax dollars will be used, and, importantly, the government's economic outlook for the next couple of years. This outlook can be a significant indicator for investors. Key economic theories: Keynesian versus Monetarist. There are different schools of thought on how the economy works and how fiscal policy should be used. Let's look at two prominent ones. Keynesian economics. This theory advocates for direct government intervention to achieve economic growth and stability. In a recession, Keynesians believe the government should increase spending and lower taxes to boost consumer income and spending. This, in turn, encourages businesses to expand and hire more workers, reducing unemployment. During an economic boom, the policy shifts to lower spending and higher taxes to prevent inflation. Example: during a downturn, the government might launch a large infrastructure project, like building new roads or bridges. This creates jobs, puts money into people's pockets, and stimulates demand for goods and services. Monetarist theory. Monetarists argue that governments should not use fiscal policy to influence the economy. They believe that changes in the money supply are the primary cause of economic fluctuations. Therefore, they advocate using monetary policy, controlling the money supply and interest rates, to manage economic instability and inflation. Monetarists suggest the central bank should expand the money supply at a steady, predictable rate, typically 2% to 3% per year, to control inflation and create a stable foundation for economic growth. We'll delve deeper into monetary policy in our next section. But for now, remember that fiscal policy is the government's powerful lever, using spending and taxation to influence the economic tides. Understanding its mechanisms is key to making informed investment decisions. Transition sound, smooth, informative, leading to the next section. Section 2. Monetary policy. The Bank of Canada's role. Now, let's shift our focus to monetary policy, the domain of the Bank of Canada. While fiscal policy is about government spending and taxation, monetary policy is about managing the supply of money and credit in the economy. The Bank of Canada, as Canada's central bank, has a crucial mandate to preserve the value of money by keeping inflation low, stable, and predictable. This, in turn, promotes sustained economic growth and job creation. Since 1991, the Bank of Canada has used inflation control targets, aiming to keep inflation between 1% and 3%. Why is this important? Because if economic growth happens too fast, it can lead to inflation, eroding the purchasing power of your money. Conversely, too little growth can lead to unemployment and a stagnant economy. The target for the overnight rate, the bank's key tool. The most visible and important tool the Bank of Canada uses is setting the target for the overnight rate. This is the interest rate at which major Canadian financial institutions lend each other money on a one-day, overnight basis. By changing this target, the bank signals its policy stance, whether it wants to ease, lower rates, or tighten, raise rates, monetary conditions to meet its inflation targets. Think of it this way: the overnight rate operates within a 50 basis point wide operating band. A basis point is 1/100th of a percentage point, so 50 basis points is 0.5%. The bank targets the midpoint of this band. For example, if the band is 1.5% to 2.0%, the target overnight rate is 1.75%. The bank rate is the upper limit of this operating band. It's the rate the Bank of Canada charges on one-day loans to chartered banks. This rate, along with the operating band, adjusts whenever the bank changes the target for the overnight rate. The Bank of Canada announces changes to this target rate on 8 preset dates throughout the year. These announcements are closely watched by financial markets because they send a strong message about the bank's economic outlook. When the bank lowers the target rate, it aims to make borrowing cheaper for consumers and businesses, encouraging spending and stimulating the economy. Conversely, raising the target rate makes borrowing more expensive, encouraging saving and slowing down economic activity to combat inflation. Example: If the bank lowers the target rate from 1.0% to 0.75%, it's trying to make it cheaper for you to get a loan for a car or a mortgage, hoping you'll spend more and boost the economy. Open market operations, fine-tuning the overnight rate. Beyond setting the target rate, the Bank of Canada also uses open market operations to keep the overnight rate within its target band. These operations involve two main types of transactions: overnight repos and overnight reverse repos. Overnight repos, repurchase agreements. The bank uses these when it wants to push interest rates down. If the overnight rate is trading above the target, the bank might intervene by offering to lend money at a lower rate. Essentially, the bank buys treasury bills from financial institutions on an overnight basis. This injects money into the financial system, increasing the supply of funds and causing the overnight rate to fall. The next day, the transaction is reversed. For example, if the overnight rate is 2.10% and the bank's upper limit is 2.0%, the bank offers to lend at 2.0%. Banks will borrow from the Bank of Canada at the lower rate, bringing the market rate down. Overnight reverse repos, reverse repurchase agreements. These are used to push interest rates up. If the overnight rate is trading below the target, the bank might intervene by offering to borrow at a higher rate. The bank sells treasury bills to financial institutions on an overnight basis, effectively draining money from the financial system. This reduces the supply of funds and causes the overnight rate to rise. The next day, the transaction is reversed. Example: if the overnight rate is 1.25% and the bank's lower limit is 1.5%, the bank offers to borrow at 1.5%. Banks will lend to the Bank of Canada at the higher rate, pushing the market rate up. These operations, along with the Links payment system, Canada's high-value payment system, ensure that the overnight market stays within the bank's target band. Financial institutions know the bank will always lend at the upper limit and borrow at the lower limit, making it illogical to transact outside this band. Drawdowns and redeposits, influencing cash balances. The Bank of Canada has another subtle way to influence short-term interest rates: drawdowns and redeposits. The federal government maintains accounts with both the Bank of Canada and chartered banks. The bank can transfer funds between these accounts to influence the money supply. Drawdown. This is when the bank transfers deposits from the chartered banks to its own account. This effectively drains cash from the banking system, reducing the money available for lending. Less money means higher interest rates, making consumers and businesses less willing to borrow. Redeposit. This is the opposite: a transfer of funds from the Bank of Canada to the chartered banks. This increases the deposits and reserves in the banking system, making more money available for lending. More money means lower interest rates, encouraging borrowing and stimulating the economy. So, while fiscal policy is the government's broad economic brush, monetary policy is the Bank of Canada's precise scalpel, constantly adjusting the flow of money and credit to maintain economic stability and control inflation. Section 3: The Challenges of Government Policy, Navigating Economic Realities. Fiscal and monetary policies, while powerful, are not without their complexities and challenges. Governments and central banks often face significant hurdles when trying to implement these policies effectively. It's like trying to steer a massive ship in unpredictable waters. There are always external factors and internal dynamics at play. Let's explore some of these key challenges. 1. Timing lags, the delay effect. One of the biggest challenges is timing lags. In economics, there are significant delays between recognizing an economic problem. It takes time to collect and analyze data to confirm a recession or inflationary pressure. Deciding on a policy action. Policymakers need to debate and agree on the best course of action. Implementing the policy. Laws need to be passed, programs need to be set up, or interest rates need to be adjusted. Seeing the policy's effect. It takes time for the policy to filter through the economy and show tangible results. For monetary policy, the Bank of Canada estimates it can take more than 18 months for the full effect of interest rate changes to impact inflation. Fiscal policy can also have long lags, especially for large infrastructure projects that take years to plan and build. These delays make it incredibly difficult for policymakers to act at precisely the right moment. Imagine the economy is slowing down. By the time the government identifies the problem, passes a stimulus package, and the money starts flowing, the economy might already be recovering on its own. Or even worse, overheating, leading to unintended inflation. 2. Political considerations. The election cycle. Politics often plays a significant role, creating what's known as a political business cycle. Politicians, naturally, want to be re-elected. This can sometimes lead to decisions that are popular in the short term, but not necessarily optimal for the long-term health of the economy. Example: a government might be tempted to cut taxes or increase spending just before an election, even if the national economic reality calls for fiscal restraint. Once elected, they might face a different economic landscape that requires unpopular decisions, like spending cuts, which are hard to implement. 3. Future expectations, the self-fulfilling prophecy. People's expectations about the future can significantly impact the effectiveness of a policy. If the public doesn't believe a policy will work, or if they expect it to be short-lived, they might not react in the way policymakers intend. Example: if the government announces a tax cut to stimulate spending, but consumers believe it's a temporary measure or that the economy is still too uncertain, they might choose to save the extra money instead of spending it. In this case, the policy fails to achieve its goal of boosting economic activity. 4. Coordination of policies. A large and diverse country. Canada is a vast country with diverse regional economies. What works for one province might not work for another. Coordinating federal, provincial, and municipal policies can be a major challenge. Example: if British Columbia is experiencing high inflation while Nova Scotia is in a recession, a national policy to lower interest rates to stimulate Nova Scotia's economy could worsen inflation in BC. Finding a one-size-fits-all solution is often impossible. 5. High federal debt, limited flexibility. Years of deficits can lead to high federal debt, which reduces the government's flexibility. A large national debt means a significant portion of tax revenue must go towards interest payments, leaving less money for essential programs or new economic initiatives. If the government wants to cut spending to fight inflation, but a large chunk of its budget is tied up in debt interest payments, its ability to make significant cuts elsewhere is limited. 6. Impact of international economies, global interconnectedness. Finally, the impact of international economies cannot be overstated. Canada is a trading nation, and the economic performance of our major trading partners directly affects us. For example, if the U.S. economy, our largest trading partner, enters a recession, Canadian exports to the U.S. will likely decrease, potentially leading to a drop in Canada's GDP and even triggering a recession here. Conversely, if the U.S. experiences high inflation, the cost of goods we import from them will rise, potentially contributing to inflation in Canada. Understanding these challenges helps us appreciate the complexity of economic policymaking. It's a constant balancing act, with policymakers trying to navigate a dynamic and often unpredictable economic landscape. Conclusion: your role in the economic picture. We've covered a lot of ground today. From the government's fiscal policy tools to the Bank of Canada's monetary policy strategies and the significant challenges faced in implementing them. Understanding these concepts is not just academic, it's crucial for you as an investor. Economic policies directly influence interest rates, inflation, employment, and ultimately, the performance of your investments. By staying informed about government budgets, central bank announcements, and global economic trends, you can make more informed decisions about your portfolio. Remember, the goal of economic policy is to foster a stable and prosperous environment. While challenges exist, the continuous efforts to balance growth and inflation are vital for the health of our financial markets. Keep learning, keep questioning, and keep growing your financial knowledge. Thank you for tuning in to Money Talks. Join us next time as we delve into another essential topic for your Canadian Securities Course journey. Until then, happy investing.